Tonight, the fuse is already lit. China slammed the door on silver supply, silver ripped higher, and that one move just exposed a weak point nobody wants to touch. The entire paper derivatives tower is built on trust, and trust is the first thing that dies in a crisis. Here's what actually happened. Physical silver tightened, pricing started to jump, and the conversation instantly changed. This is no longer, is silver bullish? This is, who can't deliver? Because the moment delivery gets questioned in London's OTC world, the problem doesn't stay in silver. It jumps into gold, then oil, then base metals, then straight into the plumbing of interest rate swaps and currency swaps. You're with us here, shoulder to shoulder, and we're not here to worship a chart. We're here to spot the stress fractures before they snap. Now watch the chain reaction nobody is pricing in. Derivatives aren't assets, they're promises. And promises only work when everyone believes everyone else can pay. London's OTC market is basically a private poker room. Big players, big bets, bespoke contracts, and a clearing system that leans on confidence more than collateral. It functions beautifully until it doesn't. The moment metal prices surge, the moment physical gets scarce, the moment one counterparty hesitates, the entire room goes quiet. And quiet is where panic starts. Because if silver is screaming, deliver, every dealer asks the same ugly question. If my counterparty is short silver, what else are they short? That's when the rot spreads. Not because silver is magical, but because silver is small enough to move fast and violent enough to expose leverage. Here's the mistake most people make. They treat silver as a sideshow, a shiny commodity, a speculative toy. But silver is a tripwire. It's the thin wire across the hallway that tells you someone broke into the building. If this keeps running, the risk is not price. The risk is settlement. And if settlement gets questioned, it's not just a metal story. It becomes a collateral story. Now let's talk about the part that hits you in the face, stocks. Banks don't just own assets. They use assets as collateral. They lend against them. They rehypothecate them. They stack promises on promises, like building a skyscraper out of Jenga blocks. So what happens when the bubble pops? They don't politely rebalance. They sell. They dump stocks to protect loan books. They tighten credit. They pull lines. They go defensive. And when the biggest balance sheets in the world all try to run through the same exit at the same time, the exit becomes a meat grinder. This is where it gets ugly for anyone who thinks they're diversified because they own different tickers. In a true unwind, correlation goes to 1. Everything becomes the same trade. Sell what you can. Now add the second wave, foreigners. There's a mountain of foreign money sitting in U.S. equities. They came for the liquidity, the momentum, the perceived safety. But safety is a story we tell ourselves when things are calm. When the market starts cracking, foreign capital doesn't wait and see. It runs. It tries to convert paper claims into something it can carry. And if that flood turns into a stampede, the selling isn't gradual. It's a cliff. Here's a hard question we need to ask ourselves. If the world has tens of trillions parked in U.S. stocks, how much of that can realistically get out in a panic without blowing up the price? Not much. In a rush, liquidity is a mirage. It looks deep until everyone steps on it, and then it's quicksand. So yes, we need to take seriously the scenario where indexes don't just correct, they get erased. 90% sounds insane until you remember how leverage works. Leverage turns a dip into a collapse. And the collapse doesn't need a war headline. It doesn't need a meteor. It can start with something boring, long-term yields. If long-end yields rise into a fragile equity bubble, that's like turning up the heat under a pot that's already boiling. Discount rates jump, valuations compress, buybacks slow, risk models flip. Then the selling feeds on itself. The market doesn't fall because people change their minds. It falls because the math changes. Now pause here and look at the central bank's position. Not what they say, what they can do. If inflation is sticky and debt is enormous, policymakers are boxed in. Tighten too much and you blow up funding markets. Ease too much and you torch purchasing power. That's the trap. And traps force ugly choices. When officials tell you inflation is handled, while groceries and rent still bite, that's not a victory lap. That's surrender dressed up as confidence. So if they pivot into liquidity again, call it easing, call it support, call it ensuring ample reserves, the message to the world is simple. The currency comes second. This is where the real wealth transfer begins. Because when a currency loses purchasing power, your savings don't just earn less, they shrink in real terms. Quietly, ruthlessly. Like a slow leak in a tire you don't notice until the rim hits the road. And once the public finally sees it, they don't budget. They flee. They buy goods. They buy hard assets. They buy anything that feels real. That flight into real stuff is the death rattle of a fiat regime. Now connect that to what we're seeing in bond markets. When investors only want very short-term paper, they're telling you they don't trust the long end. They're telling you they see a debt trap. They're saying, I'll lend to you for a few weeks, maybe a few months, but I'm not locking my money up for a decade. That matters because long-term yields are the gravity of the entire financial universe. If that gravity gets heavier, equity valuations float less. Real estate gets squeezed. Corporate refinancing turns from smooth to painful, and the government's own interest bill starts eating the budget like termites. So here's the uncomfortable thought. What happens when the market demands higher yields, but the system can't tolerate them? That's when the printer becomes the release valve. And every time that valve opens, your purchasing power pays the bill. Now bring China back into the frame. China didn't wake up yesterday and decide to restrict resources. This is long game behavior. They tighten the flow of strategic materials, silver, rare earth processing, antimony, cobalt, the stuff the modern world can't replace with a spreadsheet. That pushes input costs higher, squeezes manufacturing, and forces everyone else to compete for what China already controls. At the same time, they keep building a shield, gold. Gold is not a trade. Gold is an insurance policy against someone else's policy mistake. When a country steadily reduces exposure to G7 currencies, they're telling you they don't trust the future purchasing power of those paper claims. They're not attacking the dollar with missiles. They're letting the dollar collapse under its own weight. And here's the part most people miss. Commodities priced in gold can look cheap. Not a little cheap, historically cheap. That means raw materials can reprice violently in dollar terms without being expensive in real terms. That's why we can see a commodity surge at the same time stocks implode. It sounds contradictory until you see the mechanism. Stocks are a claim on future profits discounted by rates and stability. Commodities are what you need when stability breaks. When the system starts doubting paper claims, the world reaches for atoms. That's why silver matters. It's not just an industrial input. It's a vote against trust. Now let's walk into the room everyone avoids, counterparty risk. If derivative markets start questioning counterparties, the contagion spills into everything those counterparties touch. Interest rate swaps, FX forwards, credit lines, prime brokerage. And the second that happens, banks don't extend credit. They shrink, they hoard, they protect themselves first. So you get the nightmare combo. Liquidity in the system, but no willingness to lend it. That's like having water in the pipes, but the valve is shut. Central banks can flood reserves into banks, but they can't force confidence between institutions once fear takes over. They can't make a dealer trust a dealer. They can't make a counterparty feel safe. Confidence is either there or it's gone. And once it's gone, everything reprices. This is why rule changes start showing up. Capital requirements get adjusted. Certain assets get treated as safer on paper to encourage banks to hold them. And every one of those adjustments is a clue that the system is trying to duct tape itself together. Now look across the ocean. When regions with weak growth, heavy bureaucracy, and political fragmentation hit a global funding crunch, they don't get a soft landing. They get a hard stop. Credit tightens, energy costs bite, and policymakers argue while the market moves. And the market always moves first. So if the US wobbles, the rest of the world doesn't sit comfortably. It tilts with it. Now, if China is positioning for a world where trade settlement shifts away from the dollar, they don't need to announce anything tomorrow. They wait until the dollar is visibly wobbling. Then they offer the alternative at the exact moment the world is desperate. That's how power shifts. Not with a speech, with a solution. A new settlement structure, a stronger regional network, a currency system anchored to something that can't be printed. You don't need to believe in a perfect gold-backed headline to understand the incentive. If trust in fiat cracks, anyone offering discipline looks attractive. So the real question is not, will they do it? The real question is, when the pain hits, who has the plan ready, and who doesn't? Now, we have to be brutally honest with ourselves. The political system is not designed for austerity. It's designed for promises, and promises are expensive. So in a currency credibility crisis, the path of least resistance is always the same. Print, patch, postpone. That's why we can't treat 2026 as just another year. It could be the year the public finally understands the difference between money and credit. Money is final settlement. Credit is somebody else's promise. When times are calm, credit feels like money. When times are rough, credit shows its teeth. If we're wrong, where will it show first? It will show in stress spreads, in repo, in delivery delays, in sudden technical outages, in banks quietly demanding more margin, in temporary measures that never go away. And when those signals appear, the window closes fast. So we keep it simple. We're not gambling, we're measuring. Now let's zoom back to silver for 1 second because it's the spark in this room full of gas. If China restricts silver flow, the market has to find supply somewhere else or ration demand through price. And rationing is messy. It forces uncomfortable behavior. Fabricators fight for metal. Dealers widen spreads. Paper markets get tested. And every time the price jumps, margin calls multiply. And margin calls are where leverage dies. A short doesn't care about your thesis. A short cares about cash today. So the higher silver goes, the more it pressures weak hands, who thought they could roll forever. And once one big player flinches, everyone looks at everyone else. That's when the poker room becomes a fire drill. Now think about what that does to gold. Gold is the reserve asset that sits behind central banks. It's the barometer for trust. If gold is firm while stocks wobble, that's the market whispering, something's off. And if gold starts moving aggressively while officials are easing, that whisper turns into a shout. Gold doesn't predict exact dates. It signals regime change. And regime change is when old playbooks get people crushed. So what do we do with this? We stop treating rising equities as proof of safety. A bubble doesn't feel like a bubble while you're inside it. It feels like normal. We stop treating policy promises as guarantees. Central banks can manage narratives. They can't repeal math. We accept that commodities can be the uptrade inside the down world because they are the exit from paper claims. We treat China's resource behavior as strategy, not noise. When a country controls processing and tightens exports, they're moving chess pieces, not posting memes. Now, here's the part that will make some people uncomfortable. If your wealth exists mainly as someone else's liability, bank deposits, long-duration bonds, derivative claims, you are exposed to the exact thing that breaks in a trust crisis. That doesn't mean you sell everything and hide in a bunker. It means you convert a slice of credit-based wealth into assets that don't require permission to exist. Gold, select commodities, real productive assets, things that don't default because they aren't a promise. This is educational. We manage risk. And yes, there's a psychological war coming with this. Because when the system starts cracking, the headlines will be designed to confuse you. One day they'll say soft landing. The next day they'll say unexpected volatility. Then they'll say temporary liquidity measures. Then they'll blame a scapegoat. But the truth is simpler. If the currency is being sacrificed to keep the system standing, purchasing power is the casualty. And purchasing power is your life. So we stay awake. Now watch this final hinge. If long-end yields jump and equities roll, foreign capital runs, and banks sell collateral, policymakers respond with liquidity. That liquidity pushes commodities higher. Higher commodities push inflation expectations higher. Inflation expectations push yields higher again. That's a feedback loop. A loop that eats portfolios. And in that loop, silver is not the hero. Silver is the alarm. So here are two questions we want you thinking about, and we want you in the comments with real answers. If silver is rising because physical is tight, what happens to a paper market built on "we'll settle later"? And if policymakers ease into inflation to save the system, what do we want to be holding when the public realizes it's not prices rising, it's the currency falling? One more thing we can't ignore. In a real dollar credibility scare, it only takes one major block to say, we're settling differently. Not because they worship gold, but because they need a firewall. The moment that happens, the dollar doesn't slide in a smooth line. It gaps. Everyone tries to front-run everyone else. Companies pre-buy inventory. Governments stockpile fuel and metals. Importers scramble for hedges. Ordinary people feel the squeeze and start converting paychecks into stuff. That's when inflation stops being a statistic and becomes a weekly shock. And here's the cliffhanger. The switch usually happens quietly at first, then it becomes contagious. And once it's contagious, it's irreversible. When you notice it, it's already late. That's why we move before the crowd moves. We're not ending this with a neat bow, because crises don't come with closure. We're ending with a warning. The next phase won't be announced. It will be felt. It will feel like small changes at first. Wider spreads, weird headlines, sudden caution from banks, policymakers insisting everything is fine while you feel it getting expensive. Then it accelerates. And by the time the crowd agrees it's real, the exits are already jammed. So stay sharp. Keep measuring. Don't marry narratives. Watch the pipes, not the speeches. And if you want us tracking the signals with you, hit subscribe. Short, simple, do it now. Because when the chasm opens, we don't get a second chance to pretend we didn't see it coming.